pass this on. I'll pass this on to Saurabh now to introduce InCred Wealth and also our session going forward. Thank you so much.
Thanks, Radhika. Thank you, and a very warm welcome to everyone on the call. It's a Friday evening, and we'll try to keep the session as interesting, engaging, and interactive with all of you. So to begin with, let me start, with an introduction to our group, and then we'll move on, quickly onto the topic for the day. So allow me to present my screen. Okay. So, a little bit about InCred Wealth first before we get on to, what is it that we want to cover in the market linked debentures or the structured product, concept. So InCred Group was started by Mr. Bhupinder Singh. He's our founder. He founded the group in 2016, started with InCred Finance, which is the NBFC arm of the group, in March of 2016. And InCred Finance deals with primarily consumer finance aspect of lending. Then it was InCred Capital is what he started with later on in 2018. Within InCred Capital, which is more of a end-to-end financial services part of the group, we have Wealth as the setup, which started in late 2019, followed by InCred Asset Management. So we specialize in equity, PMS, AIF strategies on that platform, and soon to diversify into other aspects of investing on the PMS side and the AIF side. We have a presence in also investment banking space. MAPE Advisors is the firm which we acquired, and through them we target the mid-market segment corporates for M&A deal advisory on the IB side. We also have an institutional broking arm on equities, where we can provide research, sell-side research, as well as equity broking. On the debt market piece, we are present through our wholesale debt market team. This team came on board around a year back, and we've already been rated amongst the top 3 debt market providers on the WDM side. And besides this, we also have a presence globally. So we are present in Singapore and Dubai under InCred Global Wealth, where we do have private banking teams, as well as we are present, in the capacity of fund managers and and as advisors as well. So Bhupinder, along with Anshu, started this in 2016. Anshu, I'm sure you all have known him in his previous avatar, where he was the co-CEO of Deutsche Bank Global from 2012 to 2015. Bhupinder, for his, by way of background, he's also been a Deutsche Banker. He's worked with Deutsche Bank for almost 16 years in various capacities in London and in Singapore. Most recently, he co-headed their corporate banking business out of Singapore, and he's also managed their fixed income, equities, and IB divisions for the bank. I've broadly covered, in terms of what businesses do we have under InCred Capital and InCred Finance. In terms of key investors who are on our cap table, we have Mr. Ranjan Pai's family office, Ranjan Pai of the Manipal Group, who's invested with us, apart from Mr. Gaurav Dalmia through his family office. Then there are private equity investors in the firm on the cap table, likes of Investcorp, erstwhile IDFC Equity, Paragon Partners, Moore Ventures, and more recently, it's KKR, which is also invested in us, through a reverse merger that's happened. That, along with ADIA as well as Texas Teachers Fund. In our journey so far, on the NBFC side, we have a book now which is close to 3,000 crores of assets. On the number of customer side, we have more than 4 lakh odd customers in the finance team. As far as InCred Wealth is concerned, it's headed by Mr. Nitin Rao. Nitin comes with a 30-year plus experience. He's a veteran in the wealth space. He's sort of set up the entire HDFC private banking platform, and he joined us, since the inception of this firm. we, in terms of our differentiation, we have an end-to-end product suite, right from off-the-shelf mutual funds, bonds, equities, to complicated products which come on the AIF platform, unlisted equities, etc. With client centricity being paramount for us. To give a little bit in terms of where we stand in our journey in building up the wealth business, we have now close to 11,000 crores of assets under management in the wealth business. We are spread across 10 cities, more than 80 plus private bankers, who are headed by or managed by a strong 8-member, managing partner team. So that's a bit about what the group and what wealth stands for. Let me now move to the topic for the day, which is on market-linked debentures. So I'm sure some of you, if not all of you, have heard about market-linked debentures as a concept. Stay with me. Yeah. So as the name suggests, what market-linked debentures actually stand for is nothing but a structured product or a product which is created or designed in a manner that it helps play out certain views in the market, and at the same time provides returns in a better risk-adjusted manner and are also tax efficient. So what you can see on the screen right now is.
Can you just put it in a presentation mode, please?
Sure. Is it visible now?
Yes, yes.
Okay. So generally when we interact with our investors, there are certain key requirements or asks that an investor really wants from the investments that we offer to him as his trusted manager. One of them could typically be, they want a solution where they don't really want any sort of losses in the investment. I mean, who wants to see their portfolios getting drawn down, right? At the same time, they want to ensure that they're able to participate a bit if the market sort of rallies. There are investors who say that, look, we don't mind taking a little bit more risk, but at the same time, we want certain surety of income or a higher probability of generating certain returns. There are investors who might want to say that, look, my view is the market is not going to do too well. Can you design something for me which helps me generate returns even on the downside? So these are some of the different conversations that generally come up, or requirements that come up when we speak to investors. So market-linked debentures or structured products are the best possible way in which one can participate in the markets and try to customize them in a manner that we can get as close as possible to what the investor really requires out of an investment. Very broadly, before I hand over to Aman, market-linked debentures are nothing but a form of NCD, where the payout or the coupon is linked to the performance of an underlying index or a stock, or it could also be a basket of stock or commodities, etc. There are two broad types of market-linked debentures. The ones that we really focus on or we bring to our investors are the principal protected ones, wherein they're designed in a manner that if held to maturity, the principal that the investor invests into these products stays protected. So you really don't see a drawdown in your capital. And then there are further nuances in terms of how we can play out equity markets or debt market returns and try and improvise on returns. So that's broadly what I wanted to cover and set the tone for the next leg of the conversation. So now I would like to invite Aman, who will get into the specifics of structures, the types of it, how are they classified, how are they designed, and maybe a little bit on taxation, and then we could open it up for questions after that. So Aman, over to you.
Thank you, Saurabh. Good evening, everyone. So I'll be discussing about the MLDs that are traded here in India. I'm just sharing my screen. Sir, can you confirm if my screen is visible?
Yeah.
Thank you. So essentially, there are two type of market linked debentures or structured products. The first one is debt MLDs. So debt MLDs are nothing but a substitute to your bonds or fixed deposits that you invest, and they have a they have a condition linked to the market such that you will achieve an indicative returns. So I'll give a simple example. So let's say I'm saying that if, let's say, if Nifty doesn't fall by 75% of the initial level, then I'll be giving you an IRR of 9%. And if Nifty falls by like 75%, then I'll be giving you the principal back. So this is a kind of debt MLD where the investor knows that since this is a condition which is highly unlikely to like get executed. I mean, a fall of 75% in the index is very near to impossible. So the client can invest in debt MLDs if they want a fixed coupon or a fixed return after a certain tenor. And so this is the first kind of MLDs that are mostly traded here in India and known as debt MLDs, which come with a fixed coupon. The second type of MLD that we deal with is the equity MLDs. So equity MLDs are basically linked to the performance of Nifty. So these MLDs are actually created using a combination of fixed income instruments and derivatives. By derivatives here, I am talking about Nifty derivatives. So all the products that we offer or like the market participants offer are mostly linked to Nifty here in India. So there's a reason why it is linked to Nifty. The reason being that we have all sorts of liquidity and contracts available in Nifty, which are being traded on the exchange here. So these like derivatives are like shorter dated derivatives or like even longer dated derivatives. So I'm just giving you a simple example how we manage your funds that come in and structure it. So let's say we collect 100 rupees from you. So we'll give a portion to a zero coupon bond, which will convert into 100 after the tenor, and it will give you the principal protection at maturity. While the remaining amount, I'll use it for trading in Nifty derivatives, which will give me indicative returns as per the payoff, which is already shared with you. So I'll talk about more about the payoffs that we can achieve with the help of Nifty derivatives. So I'll shift the first example. So this is a MLD which says that I'll give you 130% times the Nifty performance. So the tenor of the product would be 38 months, and we will observe Nifty for first 34 months. So let's say whatever the Nifty return is in the first 34 months, we'll multiply it by 130 and give the coupon at the redemption date. So I'll give you some scenarios related to this product. Let's say if Nifty stays where it is, like there's 0% of return in Nifty. So this product will give you 130% multiplied by 0, that will be 0. But let's say if Nifty gives a 5% return, it will again multiply it by 130%, and the return on the MLD will be 6.5%. Now this is a flat market condition. When the markets are bullish, if you have a bullish view on the markets, you can invest in these kind of MLDs where, like, let's say if after 34 months, the Nifty returns are 40%, the MLD will be giving you 52% of returns. So you can generate alpha over here. So this is a payoff which was already stated to you. The product manager has no discretion while investing in other securities, or like he has no confusion like where to allocate or where to select which stocks to select. We are, since trading in Nifty derivatives, we have a control on the payoff, and these are sophisticated algorithms and strategies that are used to generate the payoff. So these are used, and actually this is a kind of payoff that you'll be able to achieve. So if you are, let's say today, if Nifty is at 18,000 levels and market reaches to, let's say, 22,500, so you'll be getting a higher return if you had invested in, as compared to if you have invested in an ETF, Nifty ETF, or a mutual fund. This MLD will be giving you a higher return because we are giving 130% participation in the Nifty returns. By participation, I mean basically the multiplier of the returns. In this case, it is 130%. So then here we are also ensuring that your capital is always protected. So even if we have a drawdown in Nifty, the MLD will give you the principal back at maturity. The next type of payoff that you can achieve through these MLDs is, let's say if you have a mildly bullish view on the market, and I'll tell that, okay, if let's say Nifty goes from 0% to 10% over the tenor, I'll give you 250% times the Nifty return, but it will be capped at 25%. So the payoff looks like this, where you can, like, let's say if you have invested at 17,000 levels and Nifty doesn't rally above 10%, you will be anyway making 250% times the Nifty returns, and the returns will be capped. But we ensure that these levels are such that the client can always generate an alpha historical if compared historically. So this is just an example. The numbers, the values can be changed as per the client's requirement. The tenor can be changed. The upper barrier, that here it's 25%, it can be changed. All these things can be customized for clients. So this is what MLDs bring to us. So another type of payoff I'll show you, like, let's say I have a structure which says if Nifty doesn't go above, if Nifty doesn't go above 16%, I'll anyway give you 16% return anywhere. Like if Nifty stays below the initial level also, or even it is giving 20% negative returns, I'll be still giving you a 16% absolute return on your principal. But what happens if Nifty goes above 16%? So I'm saying if Nifty goes above 16%, I'll be giving you the Nifty returns. So these kind of products are for clients like who want a minimum coupon and then also want to participate in the Nifty upside. So the other strategy that we can obviously talk about is, let's say a client has a view that Nifty will be bullish, yet I need some fixed coupon with my product. So I'm saying, okay, I'll be giving you 16% fixed, and I'll be also giving you 40% participation in the Nifty performance. So these kind of products enable the client to achieve their views along with a predefined payoff function. So the issuer of these MLDs will be paying the client as per the coupons that are predefined on the investment date. So I'll talk about how these structures are made now. So let's look at this structure. So we are giving you 130% participation in the Nifty returns. So what am I doing here? So I'm not doing nothing, but I'm just buying Nifty call options. These call options are long dated options, so which are highly illiquid, but we have counterparties, like we have trade arrangements who trade these kind of long dated structures. Long dated call options basically. So these call options can generate the payoff as per the client requirements or as per the coupon payoff function that has been predefined. So let's say there's another payoff where I was giving a multiplier of 2.5x. Like if Nifty goes from 0 to 10%, I'll be giving you the return of, let's 250% multiplied by the Nifty return. For example, if I'm telling that the Nifty returns is 5%, I'll be giving you a return of, the MLD will be giving you a return of 12.5%, basically 5% multiplied by 250%. So these structures are made using call spread options. So the strategy that we will be deploying is the call spread. Or the other way we can look at it, we can also do short put spread for achieving these kind of payoffs. The other strategy that we have discussed is giving the client a minimum fixed coupon and Nifty participation if Nifty goes above 16%, sorry. So here basically we will be buying call options, but these will be out of money call options. Now, these kind of structures can be difficult to like do it on a retail client's portfolio. But since we are doing it on a, like, a big book size, we can manage these structures. So there's the last strategy that we were discussing, that the client will be getting 16% of absolute return plus 40% participation in the Nifty. So here basically we'll be buying at the money call options, but we'll be buying the quantity a bit less so that the participation is 40% only and not 100%. While these structures are complicated while making and pricing, but the product managers ensures that the client's principal is always protected. So these are few of the payoffs that are commonly traded or being used by investors to protect their capital along with getting Nifty participation or upsides or achieving alpha over Nifty performance over a tenor of like 3 or 4 years. These are some of the structures that we majorly do, but these structures can also be customized as per the client requirements, and anyone can get in contact with us, like how to if they have a view, and we can obviously, like as per the client's requirement, we can come up with structures that will be more suited for the client. Now I'll move on to the taxation on these. So basically there are two types of MLDs or structured products in India. The first one is the listed debentures, and the second one is unlisted debentures. So the listed debentures are listed on the BSE, and the unlisted debentures are not listed but are placed through private placement offers. And I mean, they have a proper ISIN, they are reflected, they will be reflected in your demat accounts, and the issuer of the MLDs will be liable to pay whatever is mentioned in the term sheet or the payoff function at the end of the maturity, I mean end of the product tenor. So how capital gains taxes are applicable here? So whatever capital gains you have made, it will be divided based on the holding period of the MLD. So let's say if a client is holding a listed debenture for more than 12 months and exits the MLDs, so the capital gains tax will be only 10%. While if the client holds a listed debenture for more than 12 months or less than 12 months, but until maturity, it will be like the capital gains tax will be included in as per the regular income marginal tax slab. So the second one is unlisted debentures. So here the client has to hold for more than 36 months to get the taxation benefits. The tax applicable will be 20%, while if the client doesn't unwind it, I mean doesn't sell it before maturity, the client will have to pay the taxation as per the regular income or marginal tax slab. So this is the taxation that is applicable for gains through MLDs. Now I'll shift to what kind of risks these MLDs have. So basically there's an interest rate risk. So these interest rate risks influence the value or the daily valuation of weekly or monthly valuation of these products. But here what happens, the clients who are investing it for the whole tenor don't have to worry about it, because the payoff is predefined and the issuer is liable to pay the amount as per the predefined coupon function. And MTM, like here, since valuations are dependent on the interest rate, current interest rates or the volatilities in the market, there can be an MTM loss. But since these products are thought to be like held till maturity or unwinded near maturity, the client should not be worried about this. Then there's a liquidity risk over here. So these products come with a fixed tenor, and there is a little or like a very less liquid market for regular trading of these MLDs. So if someone wants to exit these products, there must be a buyer for the product. So which can be arranged through the help of your wealth advisor or anyone whom you know. But essentially there is a very illiquid market for this before the product is close to the maturity. Now there is a repayment risk. Obviously, these products are issued by issuers who uh, can like default if their businesses don't go right. So there is a credit risk associated with these kind of products. But I mean, with the help of your wealth advisors, you can always look up to the credit quality and invest in these kind of debentures. That's it from my side. If you have any questions, please feel free to ask.
Thank you, Aman. I think that was very simplistically
So there's a
explained.
question, what do you mean by listed and unlisted debentures? So these listed debentures are listed on the BSE, the WDM segment of BSE. These debentures are listed. So once the listing is done, you can get the term sheet, the contract details, and the rating rationales, everything on BSE. And these can be traded on ICCL exchange as well. Any other question?
Yeah, so if you have any questions, participants, you can just use the Q&A box, or you can raise your hand and we'll unmute you to ask your question.
So I'll wait another like 10 seconds. If someone is having any question, please ask.
I think maybe I can ask one question, Aman. Am I audible?
So there's another question. In light of rising interest rate, inflation, and falling markets, what is the potential of MLDs? So when you're investing in an MLD, there's a predefined payoff function or the coupon function. So you can decide on your own whether you have to invest in this MLD, which may come with a guaranteed coupon, which may come with a guaranteed coupon plus nifty upside participation. So these interest rates and inflation and falling markets can be like those things will not matter if you are having a particular fixed payoff function at the end, at the beginning of your investment, right? You will have a contract where all the payoff function is mentioned. So these interest rate or inflation or falling markets will not impact the payoff or the payout on your MLDs. If the MLDs are linked to Nifty performance, obviously Nifty performance will have an impact, but it will be as per the predefined payoff function.
I think, Aman, sorry, I wasn't audible sometime back. I think very simplistically explained by you. I would request the participants to please use the Q&A box to ask their questions, or they can also raise their hand and we could unmute them. You can take the next question, Aman.
Yeah, thank you. So what is the minimum interest in? So these products come with a face value of 10 lakh rupees. So if different issuers can have a different face value, currently InCred, the MLDs that InCred does are having a face value of 10 lakhs and can minimum amount that is required to be traded is 10 lakh rupees.
The next question is there a rating of these instruments? And if yes, how do derivatives risk get factored in?
Yeah, so as I said, there are two types of debentures, listed and unlisted debentures. So the listed debentures have to have a rating before getting listed. That is a rule by SEBI that any instrument that has to be listed must have a rating. And the rating is based on the issuer profile more than the product itself. So as I said, the rating is more dependent on the issuer profile rather than how the payoff structure is. So derivatives risk do not get factored in because it is automatically understood that the issuer is managing the derivatives positions effectively. I mean, the derivatives part is not the challenge here because we have sophisticated algorithms and strategies that will achieve the payout of the investor.
I think we'll wait for a few more questions. Okay, there's one more question. Okay, you've already answered this. What is the amount required for customization? I think you've mentioned that already, right?
So for any particular like if I can speak about InCred, then the amount of the minimum amount required for customization is 15 crore for now.
Sure, that helps. Saurabh, do you want to touch upon, what role it plays in the overall asset allocation of the client?
Yeah, okay.
Or
I was going to come to that point, waiting for some of the questions to be answered. Uh, from an asset allocation perspective, from an asset
Aman,
allocation perspective, sorry.
Aman, is your speaker off?
Okay, sorry for that. So from an asset allocation perspective, I think MLDs play a very critical role. Let's put it, into two baskets. From an equity allocation perspective, like Aman shared some of these payouts for you guys. There's a 130% participation in Nifty movement uncapped, or there's a 250% participation, etc. What it indicates is that in an uncertain market, or where one does not really foresee what sort of returns expectations one can get from the market over the next 1, 2, or 3 years, that's when these structures in your portfolio equity allocation make immense sense. For example, we did a short study at our end, wherein over the last 5-year data for almost 15 large cap funds sorted by their AUM. So basically all the top large cap funds which are in the market, which most of you as investors would have invested in or are investing in even today. If we were to look at the 3-year holding returns and compare that with, say, the Nifty Total Return Index, which means I compare it to the Nifty's performance, which accounts for the movement in its price at the same time, adding also to the dividend yield that it generates on an annual basis. So what we observed, and quite surprisingly, is that almost 67% of actively managed large cap mutual funds over a 3-year period have underperformed the Nifty Total Return Index. In fact, this number slightly goes higher when we compare it to the Nifty Total Return Index over a 5-year period. And the alpha on an annualized basis, or rather the lack of alpha on an annualized basis, that these funds have not been able to generate vis-a-vis the Nifty or their stated benchmark, is anywhere between 1 to 2% or 2.5%. So the point is, as investors, you're paying a reasonable fee for these mutual funds, for the manager to actively manage it, but at the same time, we do not. The fund manager is not able to generate alpha on most of the occasions, or 2/3 of the occasions. So that's where structured product makes sense, because even if Nifty, for that matter, over the next 3 years generates, say, a 30% return absolute, and if the structure provides 130% participation, it means that as an investor you will make 1.3 times of what Nifty is given, which is 39%. Also, as Aman explained, the taxation on the structure, depending on whether it is listed or unlisted, varies between 10% or 20%. And net of taxes, it makes great returns. So as a practice, or as a strategy, what we advise our investors basis this data is that for your large cap allocations, rather than allocating large amounts into actively managed large cap funds, or to maybe some of the ETFs, because ETFs and index funds are in vogue these days for their cost effectiveness. But what they do is at best give you index returns. So this is a strategy which will, with a certain level of visibility, give you better returns as far as your large cap allocation is concerned. Coming to the debt side, and someone I saw on the chat panel ask a question around rising interest rates, and how does a structured product help. So we've seen just last week, earlier this week, RBI come out with a 40 basis point increase in repo rate, and it's clearly indicated, and in our opinion we believe that there is another 75 basis to 100 basis of rate hikes on the cards as far as RBI is concerned. So any investments you do in your debt mutual funds, or even in your bonds, you will see erosion in value of those bonds as long as interest rates keep moving up. Of course, if you hold them to maturity, it's a different story. But what structure helps you do is, it helps you lock in a particular yield right at the beginning. And at the same time, if the structured product or the MLD is listed, post 1 year, it gets treated from a taxation perspective in lines with any other listed bond or debenture. and the tax that you have to pay on your returns is only 10%. So from that perspective, on a post-tax basis, this becomes a much superior product. It also does away with the fact that you will keep seeing that volatility in your debt returns, even when interest rates are moving up. So these are the two ways in which we normally recommend our investors to look at structured products and allocate at least anywhere between 15 to 20% of their allocation to these sort of strategies.
Thanks, Saurabh. I think there's one more question which has come in, which says, is InCred the issuer or is it some other firm? Any examples for this?
So InCred is the structures that we like Aman was introduced. Aman is the guy who actually structures these products. So the payoffs or the combination of call options, put options that he mentioned during his presentation, this is something which he does at his desk. And the issuer of these structures is InCred. So like I mentioned, we have two entities in my introduction earlier: InCred Finance, which is the consumer-oriented NBFC, and InCred Capital, which is our end-to-end financial services fee-based entity. So we issue structures out of both these entities, and these are managed, structured. All the payoffs, everything is designed at Aman's desk. So there are of course other issuers in the market, who've been there issuing structures in a similar manner like we have, including a few foreign NBFCs as well who've been operating in the country. Another question talks about, does InCred have a 1-year, 2-year structure also? Yes, we do have. In fact, just last week, we closed a 18-month structure. Typically, for any listed structures, we will keep their maturities upwards of 12 months purely from a tax benefit point of view. And we keep coming out with issuances across anything between a little over 12 months to up to around 36, 38 months. Depending on our view on the markets and depending also on the appetite that we have from the investors. Aman, if you want to add anything to this.
Yes, Saurabh, we will be doing 1 year, 2 structures depending on the client requirements and depending on the product kind of returns that the client wants. So typically a 1 year or a close to 2 year structures mostly have a fixed coupon kind of structures, while if they want to participate in Nifty performances, usually the tenor of the products go above 2 years. But we have 1 year, close to 1 year or 2 year structures as well.
I think we have one more question which has just come in.
Any other question?
Yeah, so the last question I think which has come in is, do investors have an option of daily trading in listed debentures?
So I have another question, that do investors have an option of daily trading in listed debentures? So these listed debentures can be traded on a daily basis, but again, there should be a buyer and a seller at the exchange. So if we have the counterparties, we can trade on a daily basis.
Thanks, Aman. Thanks. I think with that, I think we can close today's call. I don't see any more questions. I think this has been, I hope all of you have, appreciated the insights out of today's session. And of course, all of your relationship managers are there and you can get in touch with them for the latest structures that are available with us. Apart from that, of course, like Saurabh said, we are one of the most unique investment platforms today, where we are able to bring literally all kinds of like a one-stop shop for any investments that you would want to invest in. So thanks for that. Saurabh, if you have any closing thoughts to add.
Thanks, Radhika. I think we enjoyed the session. We appreciate the questions that you've put forward, and we've made an effort to answer it as sincerely as possible. Structured product is a very interesting subject, very vast, and the amount of customization that we can really do to accommodate almost every other viewpoint that an investor has in the market. The opportunity over there is immense. So, through your relationship managers, do feel free to reach out to us, to engage with us, to try and see, the different ways in which we can incorporate your views. And we'll be happy to, work with you and add value to your portfolios through this unique product that we have and we specialize in. So that's all what I wanted to add. Thanks, Radhika, and over to you.
Thank you. Thank you, everyone, for joining us. It's a Friday evening. Have a great weekend ahead. Thank you so much.
Thank you, everyone. Have a great weekend. Bye.
Thank you, everyone.